My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Kramer. Welcome to Mad Money. Welcome to Kramer. My friends, I'm just trying to save you some money. My job is not just to entertain, but to explain. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Look, panic is not a strategy, okay? And I make that point over and over again because I don't want you to sell when maybe you should be standing pat or even doing some buying. And today was a day that proves my point. Today where the averages opened down horribly, right? The 9th straight lower opening, only to rebound. And the Dow finished down 349 points. S&P slipped 0.23%, but the Nasdaq actually eked out a gain of 0.10%. Now, this morning, wouldn't it have felt great just to sell everything, to liberate yourself from your losses, to pick up the pieces and go home? And you would have been dead wrong. Dead wrong, which is why I counsel not to do it. Yet this morning, when faced with a hideous opening, with most indices down almost 5%, it sure looked like we were going to have another Black Monday in our hands, didn't it? That's one where stocks closed down more than 20%. Now, if you thought we were headed for Black Monday, then you would have happily sold down 4% near the open. But I didn't make that call. Why not? Well, let me walk you through it. Full disclosure, there's no certainty we won't face the same situation again, but you and I will do it together. I'm certainly not calling a bottom here, not with this trade team's ill-advised strategies. I mean, I don't even know if they know what they're doing. The endless down openings also can't last. I am saying that it might be too late to sell, though. And you have to start thinking about what you might be worth buying on the next dip, as there will be one. I think there's plenty of bargains there for the sell-off, especially with the oscillator at minus 8.7. Buy! So why didn't we panic this morning? Why did I say stay the course? First, I assessed what kind of sell-off this is. Do we have a problem that's systemic? Meaning there's actual weakness in a rot in our institutions that can't easily be undone. Now, my partner David Faber and I discussed this very point this morning. We agreed that we needed to take the financial crisis scenario off the table because our institutions are strong. And we don't believe that the whole economic system is in jeopardy. We don't believe that major banks will fail. We definitely don't like the situation, for heaven's sake, and it's likely we're headed for recession because of the president's ill-advised plans. But we'll pull out of it one way or another. It's not going to be the global financial crisis number 2. And that's important because if you look at the 15% downturns we've experienced in the last 4 years, the vast majority of times you had to buy, not sell. Normally, when we're down 15%, we actually have seen the worst of it, or the market becomes viable again, unless it's systemic problems like the financial crisis. You have to assume that, yes, indeed, the worst may indeed be behind us. Second, you had to assess the proximate cause of what happened. In 2007, it was the massive leverage in the system affected a huge number of financial institutions. Now, but looking back at most 15% declines, the proximate causes were usually because the Federal Reserve tightened too much or there was a one-off event that eventually resolved itself. Right now, we're clearly looking at a one-off event, the president's decision to enact shockingly high, perhaps, let's just say, even dangerous high tariffs. As long as the tariffs stick, our economy is in real trouble. But it looks like the president doesn't care. He should always care, both short and long term. That's part of his job. That said, the stock market almost always bottoms before the economic indicators like employment, industrial production, GDP growth. Before they start rebounding, the market bottoms. I want to thank Michael Semblis, the unbelievably good strategist, J.P. Morgan, who actually pointed that out in a remarkable talk that was also had some humor to it that he gave today. He noted that the administration lacked rationality in the way it went about this very suboptimal plan. And while it hurt the economy, it's not the beginning of a nuclear spring. Thank heavens. Third, when you just look at things purely historically, you can figure out where we might eventually bottom if things go south from here. At one point, for instance, some companies in the S&P 500 could collectively earn $300 per share. That's what I thought. And it might have traded at 24 times earnings. And that would have taken the S&P to 7,200. Yes, when the market peaked on February 19th, about 1,000 points below 7,200, it seemed perhaps that we could get there. So therefore, we're sticking around for it. Why not? Wall Street was very bullish on Trump's administration's plan for deregulation, for lower taxes, and pro-growth policies. Well, it turns out we weren't paying enough attention to the actual words out of Trump's mouth. Now, this was a moment where the president decided to rearrange the entire world order, albeit in a very slapdash plan that I think could torpedo the economy. He decided we needed extremely high tariffs in order to stop our trading partners from ripping off America. I like that, but not this high. It was not thought through. And he blindsided our friends and our companies, and yes, most importantly, you and me, the shareholders. And we count on this market for our retirement hopes. We bank on the stock market. Could be foolish, but we bank on it. So in the new regime, we have to factor in the unfathomable. Let's be clinical for a moment. Let's go over the numbers. Instead of $300 in earnings per share, we have to give the S&P earnings a $60 haircut. My judgment shared by others in the street. Take it down to 240. Keep that number in mind for a second, 240. Then we have to figure out where the price to earnings ratio might bottom. That's usually at 14.5 times earnings. That's right. That's where they bottom. That would put the S&P 500 at 3,480. That is very far from here. Now, at the ugliest today, we were at 4,835. We closed back above 5,000. That means there could be considerable downside. Yes, it could be down 30%. I'm trying to give you the negatives. If President Trump continues to press these tariffs, we got to keep that on the table. You can't dismiss that 3,480 figure because historically that's where stocks would go in this kind of worldwide trade war. One that, by the way, exceeds the smooth, holy tariffs that preceded the Great Depression. Then we get back to the proximate cause of the decline. It's all man-made. Wall Street's terrified by the tariffs, but we have an arbitrary mercurial president who can declare victory, roll these tariffs back with a stroke of a pen, and then where would we be? We'd have bought nothing. And at some point, the White House won't be able to tolerate a crashing stock market. I know this because if you're at all prominent, you mostly got called about the topic of the logic and the moves and how if you criticize them, you were wrong. For instance, I talked about, what were the odds of a crash? People didn't like that in the administration. Now, I think the potential downside will come from a president who refuses to blink. If Trump's not about negotiations or getting better deals, but just about bringing China to its knees worldwide, the market's got a problem. That's how you would see that low-end number. Of course, if you really wanted to go after China, maybe this isn't the best way to do it. Let's say you believe that China's behind the success of the iPhone and you want that to end, as I believe key people in the administration think is the case. The president just placed huge tariffs on Vietnam and India, besides a humongous tariff on China, in order, for example, to force an Apple to build its iPhones here in the U.S., despite Tim Cook's pledge to spend more than $500 billion in the U.S. In other words, the job isn't just to coerce China. It's to coerce U.S. manufacturers to come back here, away from Vietnam. That's why Vietnam had that huge tariff. Those are two agenda items, that not just one. That's important. It means there's no possible negotiation because that would encourage companies not to come back here. Sure, the tariffs could raise some revenue or promote domestic manufacturing, but they can't reverse history. And Trump wants to reverse history. It's a tall order, ill-advised one, wants to do it quickly. Which brings me to the last bullet point. There are many things that have to go right for Trump to successfully reorder the global economy in order to bring back domestic manufacturing and bring China to its knees. First, the high tariffs can't cause a spike in inflation, or else the Fed won't be able to bail us out with rate cuts. Second, he has to negotiate new trade deals very quickly for congressional members who are supposed to control the tariffs wake up. The lower the market goes, the more likely the Republicans in Congress actually throw the president's agenda under the bus. Third, he has to do it without it causing a big spike in unemployment. I think if he does get all three, he isn't going to press his bet with these tariffs. Instead, he'll find some reason to declare victory and roll them back, which is why the market didn't collapse today. Bottom line, that's why you can't panic and sell the negativity. It's why you have to stay the course. Maybe even do some buying if the averages go appreciably lower than they did at the opening this morning. That's what we're going to do. That's what I intend to do for the charitable trust. Do some buying. You should be a member of the club. You'll find out. Heaven knows there are plenty of stocks that are down enough to do some buying after today's action. Paul in Texas. Paul.
Yeah, Ski Daddy.
Yeah. Go ahead, Paul.
So the tariffs President Trump imposed on steel should reduce foreign competition and boost demand for domestic producers. Being down 30% in the last month, is the market getting it wrong on ticker CLF, Cleveland Cliffs?
I think the problem Cleveland says, it's two front. One is the balance sheet's not that good, but two, there's got to be demand. I mean, if the auto companies are really cutting back, and I think you're going to have to after initial spurt, that is going to make it so the numbers have to go lower. If the numbers go lower at Cleveland Cliffs, then the stock's going to go to 6.5. That's what happens. Let's go to Trevor in Wisconsin, please. Trevor. Trevor?
Hey, Jim.
Go ahead, Trevor.
How's it going?
Hey, Trevor. All right, how are you?
I'm doing well. I just want to give a quick thanks to your staff. You got a really great group there.
No, we do have a great group, and this is pressing times, and I want to thank them myself. I have not done enough to do that. I've got my head in the sand here trying to get the show done. How can I help?
Of course. Well, obviously, with all the uncertainty that's looming here, I know that's not good for markets and usually stocks, but I did want to ask you if there's a potential path for this to increase some momentum for Bitcoin and therefore maybe Coinbase. What do you think?
Not a bad idea. Bitcoin's down a lot. But why don't you do this? Why don't you buy Bitcoin? Why buy Coinbase? You can just go buy Bitcoin. And I think that's a good idea all the way down here. I prefer that to actually buying the stock of Coinbase. Let's go to Julio in Pennsylvania. Julio.
Hey, booyah, Jim.
Booyah, my friend. What's happening?
Hey, my friend. Hey, we've been following you for 20 years now. My mother-in-law.
Thank you.
Oh, yeah. Betty from Centralia, Pennsylvania, first turned me on to you, and just want to thank you for his advice.
Centralia, is the fire been put out yet in Centralia?
Oh, not yet. Still hot as all.
All right. 100-year fire. I never heard anything like it. How can I help you?
Hey, listen, Target, TGT. I've been looking at the chart, and it seems to be back where it was back in March 2020. Low PE ratio, especially compared to its competitors like Walmart. It looks compelling, like value opportunity right now. Do you think it's a good time to start a position, or is this market seeing something that I'm...
Okay, it's really interesting because it is at 10 times earnings, and it does trade with a 4.75% yield. I think if you're ever going to buy it, you would probably have to buy it right here, frankly. It is cheap historically. How about that? All right, now look, panicking is not a strategy. Sorry to go on so long about this, but I'm glad that we both did this together. Got to stay the course right now and get ready to do some buying. If we do go lower, then today's open. That's the game plan, okay? Retest, maybe go down a little, do some buying. Be a member of the club. You'll get the point. You'll get it before we do. On Mad Money tonight, Levi Strauss and Company's on the move after earnings. I got the CEO to break down the numbers and the state of consumer, too, and, boy, the tariffs. Then could Mag 7 stocks stand strong in this market? I'm going over each one of them, and yes, I will admit to being puzzled by Apple here. Then I'm taking calls from all across America to hear what you're eyeing in the days ahead. So don't miss my take on your very pressing questions, and stay with Kramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Kramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
After a bunch of insane sessions driven by tariff headlines, I can't wait for earnings season, if only because we'll be able to hear directly and for once from the companies themselves rather than speculating. Tonight, for example, Levi Strauss and Company put it, I thought it was a darn good solid quarter. Denim Colossus delivered solid results. Sales good, paired with a big 10-cent earnings beat off a 28-cent basis, thanks to much higher than expected margins. In terms of guidance, Levi's basically kept its outlook unchanged. Fortunately, management, like everybody else, said specifically that the guidance does not reflect any impact from the not-so-reciprocal tariffs that were announced, and they source from all over the place. At this point, the stock's down roughly 45% from its highs since last June, but it's starting to pick up after the close. So here's what we're going to do. Let's check in with Michelle Goss. She's the president and CEO of Levi Strauss. Find out what the hell is going on. Ms. Goss, welcome back to Mad Money.
Thanks, Jim. It's great to be here.
Okay, I've got to tell you, Michelle, I'm so glad we get to speak to you because there's such confusion going on. And I want to clear up one thing, first of all. There was this notion that your revenues were not as strong as the estimates. I think that's completely wrong. I think it has to do with a discontinued operation because your earnings are so strong. But let's clear up the revenues so people know why the stock should trade up.
Yeah, no, that's exactly right, Jim. We guided the quarter to be up 3.5 to 4.5, and we ended up at plus 9%. So the little bit of maybe confusion is because we did move Dockers into discontinued operations. You have it absolutely right. We had a strong quarter. I mean, a big beat on the top line, record gross margins, and as I think you just said, a very strong beat on EPS.
Now, everyone's so gloomy and everyone's telling me that everything's so bad. Levi Strauss is a great American company that should not have been able to deliver such a great number if things are so bad. Tell me what's differentiating you from the, let's say, the milieu out there that is just doing okay.
Well, I'd say it goes back to our transformation. You know, we have a very strong strategy in place, which is always leading with our brand and becoming a DTC first denim lifestyle operation. And those strategies are working. I mean, from a brand standpoint, we have never been as firmly placed in the center of culture as we are today. We're gaining market share, men's, women's #1 in the US. We are making this pivot to be DTC first. 52% of our revenues this quarter were from our DTC, so that's in our stores and in e-com, up 12%, the 12th consecutive quarter of positive growth. All regions around the world and all categories were positive this quarter. And it is a testament and a proof point that these strategies are working.
All right, so Michelle, people want to own this stock. They know the brand. They like the brand. They hear you talk about DTC. I remember we have a lot of retail investors, but they don't know why that's better than dealing with, say, a department store. Can you explain the gross margins? How much more you make on DTC than if you sell it to a department store?
Well, what I'd say is from a gross margin standpoint, as we sell directly to our consumers, it does actually help the gross margin line. Our focus and our transformation is to continue to improve the productivity of our stores and our e-com channel so that we will drive over time EBIT expansion. And you're seeing that. If you remember last year, Q4, we ended strong. Our EBIT was up for the year and the quarter. And then this quarter, again, we expanded EBIT margin significantly. So that's coming off the leverage we're seeing in the top line, largely from the DTC channel, which is driving the majority of the growth, as well as all the initiatives to address the structural economics of the business. And we're making great progress. And then I would add, in terms of direct to consumer, that's where we get to touch and interact with that consumer directly and bring the fullest expression of Levi's to them. As you know, in addition to focusing more on DTC, we're also expanding what Levi's represents, going from not only being the best pair of jeans in the world, but being head-to-toe denim lifestyle. And on all fronts, we're making great progress. And the proof is the quarter, once again, coming off of a strong quarter last Q4.
Definitely the case. Now, you have what we're all going to have to get used to. You source everywhere. Literally everywhere. Wow. And so you have to try to figure out, and you have an excellent CFO, what to guide. And it seems like it's just better just to guide, here's how business is, than try to figure out, navigate this. You can't really navigate it, correct? It's just not fathomable right now.
Well, this situation is just literally days old. And so, we are obviously focused on the underlying health of our business, driving our strategies. But I'd say more than a week ago, as we looked at the big beat we had in the quarter, we were contemplating actually increase our guidance. But on April 2nd, now we have a whole new level of uncertainty that's been introduced. So we're getting our arms around it. As you can imagine, we're driving scenario planning, and we have levers that we can pull as we better understand the current tariff situation.
All right, so let's say you and your CFO, Mr. Singh, were to be in the White House right now, and the president said to you, what do you really want? What would bring back American greatness? What would make it so the consumer does well? What would you say? What would you ask for?
Well, first, I would say that the tariff issue is an industry issue, and you talked about our suppliers. We do source. We have a very diversified supply chain. 28 suppliers manufacture around the world, but 98% of apparel manufacturing is happening overseas. So we're not in the manufacturing business. If that was available here in the U.S., we'd be open to it. It would take years. But I think, the number one thing that everybody's wrestling with right now, ourselves, the industry, and importantly, the consumer, everybody's wrestling with the uncertainty that's out there. We need some clarity and uncertainty.
Okay, so let's talk inflation. If I were to look at your pricing 5 years ago and your pricing now, how much have you had to take it up?
We have actually taken up pricing over time. I think what's really powerful, Jim, is most of that has been driven by the consumer. So our average unit retail prices, AURs as we call it, has increased over time. And that's been about the consumer pivoting to elevated and higher price point goods. And it's great for the consumer, and that's great for us, and it's good for margins. We've also, and we will reflect this in the quarter, or you'll see this in the quarter, is we're doing more full price selling. So we've actually been able to ease back on some of the promotions because the consumers are buying it. We don't need to promote it. We still do promotions at times, of course, but we're seeing more full price selling on our business, and a lot of that is coming through our direct to consumer channels.
All right, now, Chip, your predecessor, Chip Berg, is so terrific. He took me to a factory that was in San Francisco where you were making things. What happens if a trade representative, say someone like Peter Navarro, comes to you and says, hey, you're making stuff in San Francisco. I want you to make it all in the United States or else. What do you do to a trade dictator?
Yeah, well, first off, I think you're speaking to Eureka, which is a great innovation center that we have right nearby. And most of that is to help us innovate on product, et cetera. And they're doing a great job, as you can see from our very robust product pipeline these days. We have a great design and development team. But As we were talking about earlier, 98% of apparel manufacturing is happening overseas. Right. So we would be open to it if it was available, if there was capacity, and if it was economical. So, what we really want is we want to be in the best interest of our consumers and our fans, right. And that's what we're focused on.
Okay, so if you looked at your tariff situation, can you quickly shift to some of the lower tariff countries? Is that possible?
I mean, quickly, I guess, is relative. Right. We do have a lot of agility. I'd say we have a much stronger, more agile supply chain today than we did even a year ago. And we've got long tenured, decades-old relationship with our suppliers who have factories all over the world. So, of course, we've been doing this, frankly, throughout our history, is pivoting where we need to. So we will look at that. We're in it together. As an industry, we're all in it together.
Excellent. Well, look, congratulations on a good quarter. I'm glad we cleared up the revenue issue. And I think we also tried to get our best at clearing up the tariff issue. Michelle Goss, President and CEO of Levi Strauss. Thank you, Michelle, for coming on the show.
Thank you, Jim.
Excellent. Okay, Mad Money's back after the break.
Coming up, is the Magnificent Seven still all that magnificent? Kramer's taking a look at whether there's still opportunity in big tech amid this volatile tape. Next.
After a roller coaster of a session following the S&P's worst two-day performance since the onset of COVID, what the heck are we supposed to do with this market? Dow's fallen almost 16% from its highs, S&P's off 18%, NASDAQ bear market territory. Right at the center of the carnage, of course, is the Magnificent Seven, all of which are now in bear market territory. All of them. Best performer, Microsoft, has pulled back almost 24%, with worst performer, Tesla. Well, that one has been cut in half. To me, this looks like the end of the Magnificent Seven. Well, keen eye for the obvious, I guess. Remember when we watched the original movie, though? Only 3 of them make it out alive. Yul Brynner, Steve McQueen, and the kid. There's no longer anything helpful about the grouping, and President Trump's extremely high tariffs have made that even more obvious. However, these are still some of the best companies in the world. Great balance sheets, lots of flexibility, great scale. And with 7 in bear market territory, I think it's worth considering which ones you should start picking out in weakness. Of course, some of the 7 remain a lot more magnificent than the others, so I want to walk you through them. Let's go best to worst. Right near the top of the list is Amazon. That's down roughly 28% from its early February high. The main knock against Amazon is that the tariffs will crush their core e-commerce business. After all, most of this stuff is made overseas, and it's about to get a lot more expensive. But I think they've become more of a consumer staples business like Walmart because they sell so many necessities at the best prices. Plus, all retailers have to deal with the tariff problem. The question is, who has the scale to lean on their suppliers and force them to eat the cost of the tariffs? Nobody has more bargaining power than Amazon. I think it can pull a lot of its orders with China. If Chinese manufacturers refuse to eat most of the tariffs, it has all the cards. It can, I tell you, it is tough enough to be able to get lower prices. But I expect a tug of war between suppliers in China and Amazon. But Amazon's going to be willing to walk away if it has to before it's going to eat that cost of tariff. Keep in mind, this company has a lot going for it, from the sticky Prime subscription business that engenders customer loyalty to the Amazon Web Services business that has enough growth to offset any weakness in retail with excellent margins. Amazon currently trades at around 25 times this year's earnings estimates, about half of its historical valuation. Oh, that makes it a steal, frankly. Although anything can still get cheaper in this environment. Come on, this is a stock that's come down a lot. Right up there with Amazon's Meta Platforms, which looks like a relative winner from tariffs because they sell advertising, so there's little direct impact. Now, that could change if Meta becomes the target of European tariff retaliation, always a possibility, or if the trade war throws our economy into recession, another real possibility. But with Meta stock now down more than 30% from its highs 2 months ago, I think many of these negatives, including a potentially soft advertising market, are already baked in. Plus, Meta's not getting enough credit for its AI growth opportunities. Stock sells for just under 20 times this year's earnings estimate. It sells below the average stock. Not much of a discount to its historical valuation, but it's one of the highest quality stories in the formerly Magnificent Seven. Finally, yes, I would include Microsoft in the top tier, albeit somewhat grudgingly. Microsoft has one of the most durable businesses in the group. Its core office software remains essential in the workplace, and its large cloud business adds to the company's overall growth. And that's why Microsoft's only down about 24% from its highs, best performance in the group. But on the negative side, the company seems to be a bit lost in this AI front. That Copilot AI tool, I'm calling it somewhat of a bust. And its weird slow-motion breakup with OpenAI, what's that about? But at 27 times this year's earnings, I think you can justify picking some Microsoft up here. Again, you've got all the time in the world. No need to buy all at once. I do hope they stop shading down their forecasts. In the second tier behind those first three Magnificent Seven names, I'm going to put my two own it, don't trade it names. And they've hurt me, NVIDIA and Apple. The mantra still holds even though NVIDIA is down 36% from its high and Apple's up more than 30% and was down badly today. Think about that. However, even if I can admit that you're swimming upstream with these two stocks here, it was just 3 weeks ago, for instance, that NVIDIA's CTC event occurred where there was no sign at all that its AI theme was slowing. But investors want to throw in the towel, so there's just been a freight train of selling in anything AI. Trying to buy these names into weakness has gotten you steamrolled so far. So maybe you just have to step back and let the selling play out for NVIDIA. Look, let me give you some good news. It sells for just 21 times this year's earnings. This is the highest quality company in the world. It sells for less than half its average valuation over the past 5 years. That's cold comfort NVIDIA bulls like me. NVIDIA trades like there are cancellations of big orders out there. If that's not the case, I think the stock will fly. Buy. All right, Apple. As for Apple, boy, I don't know. These tariffs are going to be a killer. According to an analysis at the Wall Street Journal, Trump's tariffs will take the cost of an iPhone 16 Pro from $550 to around $850, and that's not counting the new tariffs he threatened to unleash on China today. I think the real costs are lower because of Apple's manufacturing shift to India, but even if it only goes up by half that amount, it's still a huge increase, although hopefully the companies will eat a chunk of it. And there I'm thinking about phone companies, the suppliers. Let's put it this way. There's a lot of stuff to spread around. Will Apple be able to pass that additional cost onto customers, make its products even more expensive? Will it eat the cost, crushing its margins? That's a lose-lose scenario. Right now, Apple's caught in a crossfire of a trade war between the U.S. and China, which is not a good place to be. It's probably the toughest one to really figure out what to do with. Bottom tier Magnificent Seven names start with Alphabet, stock that we just sold out of entirely for our Charitable Trust, and I feel good about that. We've owned it since 2014. My main concern, I think generative AI may pose an existential threat to their core search business. I think many younger people are bypassing Google entirely and going straight to ChatGPT. Google search is a $200 billion a year business. Plus, if the tariffs cause a recession, this is another advertising-based business that will get crushed. I think it's more vulnerable than Meta. Now, there are still plenty of reasons to like Alphabet. YouTube's arguably the most important force in media at this point. The Google Cloud platform is a top 3 or 4 offering in the cloud space and still growing nicely. Best of all, Alphabet now trades at just 16 times this year's earnings. That's a big discount to historical valuation. I just think it's too risky. They all trade at a big discount. Finally, there's Tesla, which has been cut in half from its highs. At a very high level, the bull case here is that the president's close relationship with Elon Musk should give the company major advantages as it moves into self-driving cars or humanoid robots. But man, Tesla's core auto business has collapsed, and the tariffs will be terrible for them. Musk persona is a big negative for a huge swath of customers or potential customers. Worse, Tesla still has the most expensive stock in the Magnificent Seven by a large margin, trading at 87 times this year's earnings estimates. And I'm not even sure we can trust those estimates because their auto business is in such bad shape. So here's the bottom line. In this ugly tape, the Magnificent Seven is no longer a useful framework because these stocks have much less in common when they're coming down. For me, there's a top tier of Amazon, Meta, and Microsoft, followed by NVIDIA and Apple, which face real issues for the time being, and a final group of Alphabet and Tesla, the latter of which doesn't even really belong with the Magnificent Seven anymore. Let's go to Kenny in New York, please. Kenny.
Hey, Jim. Thanks for taking my call.
Sure, Kenny.
Just a quick question. MU, Micron Technologies. Good time, bad time? What do you think?
All right, that's a great question because they have this high bandwidth business that is just on fire. The stock has come down to the point where it is selling at like a steel, actually below a steel company. Even if they cut estimates big, I don't think there's a lot of downside and there will be upside. I'm a buyer of Micron here. And thank you for calling. The Magnificent Seven has been disbanded in this tough tape because it's clear now that they have a lot less in common when they're coming down. Apple, though, is the one that I'm working on and confused. Right in front of you, I'm telling you. It's just in my mind right now. Boom, boom, boom. Trying to think. All right, much more Mad Money ahead, including our latest edition of Voice of Kramer, featuring your calls about the turbulence in this tape. Boy, do we need that, huh? Or maybe you do, or maybe I do. I don't know. Then as earnings season kicks off, I'm diving into the domino effect that these new tariffs could have on stocks and the broader economy. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Kramer. It's been a volatile few days here on Wall Street. Well, it can be tough to keep your head when the losses start piling up, as I know from my Charitable Trust. But tonight I want to open up our phone lines to hear directly from you. from the people of Kramer, so we can get through this sell-off together and to come out stronger on the other side of it. Remember, I have seen many crises in my time. It's good to have a little perspective. So with that, let's take some calls. Let's start with Patty in Illinois. Patty.
Hi, Jim. Thank you for taking my call. I've been watching you for years, and I have fond memories of some very animated conversations you had with Mark Haynes about the Church of what's happening now.
Oh, I miss Mark. Yeah, that's how it all started, when he used to come in, Reverend Jim Bob. I'm glad you remember that. Those were good times. How can I help you?
I do remember. Well, my question is, given the tariff policy, the market volatility, and all the trade disruption going on now, I've been an S&P index investor for a long time, and that served me well. But I'd like your opinion on diversifying into a European or perhaps Brazilian S&P equivalent.
Look, I have to tell you that Europe is in better shape right now than we are. If only because they have a much more expansive policy right now, in part because Germany has finally let loose. I don't think that's wrong. I will say, though, they're much ahead of us in terms of their stock market. They've had big gains. I think that you should wait till we play a little bit of catch up and then do it, because I don't want you to get into a situation where you're buying their profit taking to come into our market. Let's wait on that, and thank you for the kind words. Perot's in California. Perot's.
Hey, Jim. Thanks so much for taking my call. How's it going with these markets?
It's going well. How about you?
Pretty good. So I just wanted to get your thoughts on this. So I know with the tariffs going on, it's a pretty difficult market, and maybe we'll have another sell-off tomorrow, but we'll see. I just wanted to see your thoughts on with the tariffs happening and people kind of dipping in their toes to get a better price. Do you think that the Russell 2000 with 81% of the revenues coming from domestic sources and 19 from international would be a better opportunity compared to the S&P 500?
You know what? It would be if it weren't for the fact that there's so many horrendous stocks in that Russell 2000. Horrendous. That's why you've got to pick among things like an Intuit, which is not Russell, I know, but or a Cintas. Paychecks, those are domestic. The problem with that index, and everyone wants to do that, is because there's so much junk in it that you end up being hurt by the actual companies. Let's do individual stock selection and stay away from that index, which is so pathetic and horrible. Staying in the West Coast, let's hear from Ruben in California. Ruben.
Hey, how you doing? I had listened to you about 2-3 years ago, and I made money from you from Tesla. So I'm calling you again. I'm just a working guy, construction guy, and I ran into some money. And if you can explain it to me, like if I'm a small child or a golden retriever, I want to know what to do here. I want to know, should I buy right now? Where
I want you to fetch some stocks, okay? Fetch. All right? I mean, look, I don't want you to, have you met my friend NVIDIA? We have some fun together. This is a great time if you are just now starting out because you've gotten your first real break in the market, and that's what people are waiting for. Don't layer in. In other words, don't buy all at once. And the reason I say that is because if President Trump tomorrow says, listen, I'm done with China, no more trade with China, which he could do because that is a completely lunatic thing, but he could do it, then I think we're down back to where I expect that we could go, which is all the way down 1,000 points or more for the S&P. So I think you got to buy some tomorrow. Expect the fact that the Europeans are going to come out hard. Expect the fact that the president could do something that is, let's say, ill-advised, and leave plenty of money for the rest. So if you had $1,000 to invest, you invest $250 tomorrow, okay? Wait till it's down. It's down every single morning. I don't think you have to worry about it. Then $250 on Wednesday, $250 on Thursday, layer in, and then come in, wait on Friday because it tends to go down, and then come back Monday. You understand what I'm saying is don't do it all at once. That's what I'm trying to make out. But I do think that this is the right time, provided that it is down tomorrow. If it's up, we're going to hold off. We're just going to hold off. All right, up next is Kyle, my home state of New Jersey. Kyle.
My best friend, Jim Cramer. How are you, sir?
I'm doing fine, partner. How about you?
I'm hanging in there. I'm a bit terrified right now, but
no, don't be terrified. Do not be the wrong reaction.
Guys,
okay, go ahead.
I want to thank you guys. Last night, everybody on the whole network's coming on. You called in, taking time out of your weekend to help us guys, man. It's just.
Well,
so
no,
awesome.
it's not that. Look, I work for you. I mean, at this point, do I really work for anybody other than you? Well, honest to God. What am I going to say? No, I work for somebody in Philadelphia who's getting rid of me. No, that's not happening.
It's a privilege to be talking to you on a historic time. I think we'll be talking about this 5 years from now, But
that's fine. That's just me ringing the bell. We will be talking about this for a long time, and I think it's like you and I will be talking about it, and we're going to try to do it together.
Yeah. So here's my thoughts. I'm trying to have a contrarian view, and I really think that possibly with the 10-year coming down, it was up today, but coming down, right. And people doing a little bit of maybe panic buying of maybe cars.
Right, that's happening. That's definitely happening.
And I know there are more European cars that are going to be tariffed, but, I'm thinking we might get a little bit of a boom here, and I'm thinking about averaging into some steel companies, domestic steel companies. What do you think?
Now here's your problem with the domestic steel companies. The horrendous, the people who are against them right now around the world are going to be blunted. I think the president's going to do a very good job of stopping them. But I feel that the actual demand problem for Nucor, which is the one I look at, could be problematic. And for Cleveland Cliffs, the balance sheet's not that good. So you're running into a demand problem, even as we stop or throttle back our horrible enemies. And if Nippon Steel is allowed to get U.S. steel, they're going to flood the world with their cheap steel. They'll have a back door. So we got to hold off. But Nucor would be the one I want to buy because, man, has it come down. All right, look, I want to thank everybody for bearing with us. Look, it's been a hard couple of days. I'm upset with some of the stocks that I've chosen to own, and you are too. But we're going to get through this together. I mean, this is the seventh big downturn of my career, and frankly, I just say at this point, bring it on. Thank you for all your calls. Mad Money's back after the break.
Coming up, Kramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
Before we get into the lightning round, I want you to scan this code here. This is big news from the Investing Club. Our third annual meeting is happening soon, May 2nd in Orlando, and it is open to everyone. Members and CNBC fans alike, I want to see you there. Get your tickets now. And now it is time for the lightning round. Crazy match for every close one. I'm saying the stock that buy, sell, so don't just be under the close stock for that time. My staff prepares graphics for the plot. We plan this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's go with Dave in Kansas. Dave.
Mr. Kramer, it's Double Diamond Dave from Overland Park, Kansas.
How you been, partner? I like it. Go ahead.
Excellent. I have an equity that's down almost 30% from its recent highs.
Wow.
Gap below its 233-day moving average has an RSI of about 24. What do you think of GLW? Corning.
That's called Glowworm, where I'm from, and Wendell Weeks was on TV. I thought he was excellent. I know everyone hates the data center. I'm backing with Corning right here, right now. I like your call. I like your style. Go to Kelly in Arkansas. Kelly.
Hi, Jim. I'm long on Aurora Innovation, AUR.
It's not making money, and if we have a recession, all those companies that don't make money, they lose you money, so I'm not going to let you be in that one. Let's go to Pierce in Texas. Pierce.
Jim, during the COVID dip, a wise friend from Houston turned me on to a great Dallas company called Copart. It's been a...
Oh, my God, I love that. Salvage vehicles. Oh, no, I'm not kidding. It's a very solid company. But look, it's got a Carvana aspect to it. I like that, too. Let's go to Ross in Alabama. Ross.
Hey, Jim, how's it going, bud?
Not bad, Ross. How about you?
Oh, hey, bud. I mean, every day's a good day.
I like that attitude. What's happening?
Oh, man. Hey, trying to look forward through all of the chaos going on and trying to see maybe if some of these industrials may have a good limelight onto them.
All right.
Question I'm asking is,
LITE.
No, they've missed too many times. I'm going to have to say no to that one. Even though it's come down a lot, it had a nice bounce today. I'm going to say forget about it. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, what actually happens to a company when it has to absorb a new tariff? Kramer is breaking it down and what it means for your stocks. Next.
What happens in the real world that can justify such a horrific multi-day decline in the stock market? Okay, let's say you're a buyer of goods in China for a major American retail chain. President Trump has cumulatively raised tariffs to 79%. You'll hold a lot of cars. But the manufacturers in China know you have no other place to go for the vast majority of the things you need because nobody else can make this stuff as cheap and at scale. The Chinese manufacturers might say, we're not playing ball. We aren't paying for those Trump tariffs. It's on you. So in response, the retailer simply cancels all the orders. They can't afford the 79% either. The chain decides it'll just declare itself out of stock on those items. Ideally, the Chinese companies teeter, then give in. They eat the tariff after realizing the retailer means business. Of course, the retailer has to cut numbers and pull its guidance, though, because it doesn't have the merchandise to sell. You don't want to own that retailer's stock, do you? Now let's say a different retailer is faced with the same set of circumstances, but doesn't want to play hardball. That chain splits the tariffs 50-50 and then chooses to raise its prices to you to offset most of the damage. Sales go down, inflation goes up. You don't want to own that retailer stock either, do you? In fact, who wants to own any stocks when these situations are occurring all over the globe? When the earnings come out, you'll see lots of numbers being lowered, lots of forecasts being pulled, and lots of buys going to holds. These are the kinds of reverberations that we're all going to have to get used to. If you can't handle the missed quarters, the inflation, the tension, well, you're now getting a bounce. You can be able to do some selling tomorrow if you want to, especially if you need, let's say you need the money in the next year. But I believe you can ride through the inflation and the incessant talk about a stagflation because these tariffs are one-off, even if they are enormous. Now, all of this will play out in earnings season, which is fraught in itself. The banks start. We know there hasn't been a lot of capital markets activity, IPOs, M&A. What can they say about the future? Nothing good. Then we have the capital goods companies like Caterpillar, Cummins, United Rentals. What are they going to say? They can't be bullish. How about the consumer product stories? Too much China. We keep hearing that the home builders have something good to say because of the dramatic decline in rates, except rates actually went up a lot. Then there's tech. We could have a very similar situation to what I described with retail. President's exempted NVIDIA's chips from the tariffs. That's because of defense issues. But if those chips are in a server made in China or a package made in Vietnam or Taiwan, well, that's not exempt. Anyone who's buying that stuff will see their earnings go down. Maybe the customers pull their orders. How about Apple? It's moving away from China for its phones, building them in India, and it makes accessories in Vietnam. We know that President Trump doesn't like Vietnam, though, because he thinks it's a backdoor for Chinese exports. The White House isn't appeased by India either. They want everything built here in America, and they will not relent, which then raises the cost of an iPhone to potentially astronomical levels. Unfair to Apple, a great American company, but this trade team just doesn't care. And Apple loses sales and it makes less money on the sales it has. Do you really want to own Apple knowing that? Hence why it has shed so many points. In the end, we need to know how much of this negativity is already baked into the price of Apple and so many other stocks. I think you'll see many more days like today where we're going to have to wait and see for weeks as things play out. The averages are way down. That's positive. The inability to know that the reaction of your fellow shareholders, well, that is the problem. All I can say is get used to this. It's the new world order, whether you like it or not. And I got to say it. It's awfully hard to like. Like I said, there's always a bull market somewhere. I promise to find it just for you right here on Mad Money. I'm Jim Cramer, and I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.